forcing Trump's hand on the corporate debt crisis. In a major escalation that broke just minutes ago, a consortium of major Wall Street banks has issued formal demands on Donald Trump's business empire. We're talking $52 billion in corporate loans being called in immediately. And the fallout is already sending shockwaves through both Trump's financial network and his political operation. It's honestly hard to believe the timing of this. Trump has spent decades cultivating these banking relationships, dodging creditors, refinancing his way out of trouble. But this time, the banks aren't playing along. And when Warren Buffett himself breaks his usual silence to comment on Trump's financial exposure, something massive is happening. This isn't just about one businessman's debt problems. We're talking about a sitting major political figure whose entire empire might be crumbling in real time, and the constitutional implications are staggering. Let me fill you in on what's been happening behind closed doors at these major financial institutions. So here's the scoop on what's going down with Trump's corporate debt structure. Donald Trump built his business empire on leverage, and I mean serious leverage. Since the 1980s, he's been borrowing heavily from major Wall Street banks, Deutsche Bank in particular, but also from a network of regional lenders and foreign institutions. For decades, this worked. Trump would borrow hundreds of millions, build or buy properties, refinance when things got tight, and somehow always managed to keep the plates spinning. He became known in financial circles as someone who pushed the limits but usually found a way through. His track record wasn't perfect. There were the casino bankruptcies in Atlantic City, the failed airline venture, the luxury hotel projects that went sideways. But through it all, Trump maintained enough relationships in the banking world to keep the money flowing. Whether it was Deutsche Bank's private wealth division or smaller specialty lenders willing to take risks that others wouldn't, Trump always seemed to have access to capital when he needed it. But here's where the rubber meets the road. We're now 37 days into a massive financial pressure campaign against Trump's corporate entities. According to Politico's report from March 12th, a consortium of 6 major banks led by Deutsche Bank and including Bank of America, JPMorgan Chase, and 3 regional institutions have issued what's called acceleration notices on Trump's outstanding corporate loans. That's banking speak for pay everything back right now. The total amount, a staggering $2 billion across 17 different loans secured by properties ranging from Trump Tower in Manhattan to golf courses in Scotland to commercial real estate in Chicago and South Florida. These aren't small loans. We're talking $340 million secured by the Doral Golf Resort, $470 million backed by the Trump Tower commercial floors, $680 million tied to Chicago properties, and multiple loans in the $200 to $300 million range for various other holdings. And all of it is being called in simultaneously. This mess is unfolding because Trump's financial guarantees, the personal assurances he made to secure these loans, are now being questioned in light of recent fraud findings. The banks are looking at the New York civil fraud verdict, the $454 million judgment against Trump for inflating property values. And they're basically saying, if those property valuations were fraudulent, then our loan security is compromised. And guess who's stuck right in the middle of this financial avalanche? Trump himself, along with his sons, who are executives in the Trump organization. They're supposed to be running a multi-billion-dollar real estate empire. But here's the kicker. The banks aren't interested in negotiation or restructuring like they've done in the past. They want full repayment, and they want it within 90 days, according to the acceleration clauses in the loan agreements. And before we go any further, let's be real for a second. Banks don't call in $2 billion in loans on a whim. This represents a fundamental breakdown in the relationship between Trump and the financial institutions that have propped up his empire for 40 years. These banks are essentially saying they no longer trust Trump's word or his asset valuations. Now, back to the matter at hand. Reports from around March 11th revealed just how panicked Trump's legal and financial teams had become. According to sources who spoke with CBS News, emergency meetings were convened at Trump Tower involving not just Trump Organization executives, but also bankruptcy specialists and crisis management consultants. Trump himself reportedly went ballistic when the acceleration notices arrived, calling the bank's actions a coordinated political attack and threatening massive lawsuits. He labeled the consortium's decision as a weaponization of the financial system and even went as far as to say this was election interference designed to him before the 2024 campaign hits full stride. Talk about strong words. Essentially, Trump was calling the bank's political operatives working in concert with his enemies to destroy him financially for refusing to back down politically. And this wasn't a private conversation. Trump made sure to air his grievances on Truth Social, making it clear that he saw this as a deep state conspiracy involving Wall Street, Democratic attorneys general, and what he called corrupt judges. This announcement sent shockwaves through Trump's political operation because it raised all sorts of questions. If major Wall Street banks, institutions that have historically leaned Republican and supported business-friendly candidates, could turn against Trump's financial empire, what did that mean for everyone else in the Republican establishment scrambling to maintain their support for him? Now, this isn't the first time we've seen this pattern with Trump and institutional relationships. Trump's loyalty to institutions really only extends as far as they're useful to him, but institutions have their own survival instincts. And when someone becomes too risky, too toxic, or too legally compromised, they cut ties. We've spotted this pattern time and time again with Trump's political allies, and now we're seeing it play out in the financial world. Just think about how Deutsche Bank, his primary lender for decades, started distancing itself from Trump right after the January 6th Capitol riot. The bank announced in January 2021 that it would no longer do business with Trump or his organization, severing a relationship that had provided over $2 billion in loans since 1998. Deutsche Bank had stood by Trump through multiple bankruptcies, through fraud allegations, through everything. But after the political violence and legal exposure became too much, they walked away. Then there was Mazars USA, Trump's accounting firm for decades. In February 2022, Mazars sent a letter to the Trump organization saying that financial statements they had prepared for Trump from 2011 to 2020 could no longer be relied upon. That's accounting speak for these numbers were garbage. Mazars basically admitted that the financial statements they had compiled, which Trump used to secure loans and insurance, were so problematic that they were disclaiming them entirely. That's unprecedented. An accounting firm doesn't just abandon a major client and disclaim a decade of work unless the legal exposure is catastrophic. And let's not forget how Trump's insurance carriers started dropping him. According to court documents filed in the New York fraud case, multiple insurance companies either refused to renew Trump's policies or demanded massive premium increases once they realized the property valuations he was providing were inflated. Chubb, which had underwritten some of Trump's largest policies, reportedly required a $100 million cash deposit just to continue coverage, basically saying, we don't trust your assets to back your policies. Even some of Trump's own Republican allies in the financial world faced a similar fate when they got too close. Stephen Mnuchin, his Treasury Secretary and a former Goldman Sachs banker, maintained his relationship with Trump through the administration, but has been notably silent about Trump's current financial troubles. Mnuchin knows that associating with financial fraud, even at arm's length, can destroy credibility in the banking world forever. Now, it looks like the entire Wall Street establishment is in the hot seat, faced with the choice of absorbing potential losses from Trump's overvalued collateral or pulling the plug on the loans. This pattern is becoming all too familiar. You can be a trusted financial partner. You can provide billions in credit. You can overlook warning signs for years. But the moment the legal exposure gets too serious, the moment fraud findings stick in court, the moment your own regulators start asking questions, these institutions will cut ties without a second thought. So what did Trump do to tick off the banking consortium? Well, it all boils down to the New York civil fraud verdict and the cascading credibility crisis it created. The impasse happened because Judge Arthur Engoron found that Trump had systematically inflated the value of his assets by billions of dollars over a decade, while the banks were looking at those same inflated valuations as the basis for loan security. Ultimately, the bank's risk assessment models just exploded since their collateral might be worth 40–60% less than they thought. As the former president and current political figure, Trump decided to take a defiant stance. He appealed the fraud verdict and refused to post the required bond or acknowledge any wrongdoing. His approach seemed to be just deny, delay, and attack the judges and prosecutors as politically motivated. At first, the bank seemed to be tolerating this approach, adopting a wait-and-see attitude. Wall Street appreciates boldness and confidence, and the notion of fighting back against what Trump characterized as political persecution had some appeal in certain financial circles. But here's where things started to go wrong. As the fraud verdict dragged into its second month, with Trump still refusing to secure the judgment with actual assets, some serious issues started cropping up. Trump's appeals were getting rejected. His bond applications were being denied by underwriters, and financial regulators were starting to ask banks pointed questions about their Trump exposure. While Trump was publicly defiant and holding his ground, the banks began to realize that their loan security was genuinely compromised. Internal risk assessments at Deutsche Bank, leaked to the Financial Times in late February, showed that if Trump's properties were actually worth 50% less than he claimed, several loans were effectively underwater, meaning the collateral wouldn't cover the debt if they had to foreclose. This was the moment the banks began to sweat a little. You see, major financial institutions value regulatory compliance, risk management, and overall financial stability. They don't want to be tied to fraud findings that are making their loan portfolios look reckless. That's definitely not the stability they seek. And then Trump went ahead and made a move that, according to the banking consortium, was a serious red flag. Trump started looking for ways to move assets around and figured he should restructure some of his corporate entities. He even considered transferring properties to family trusts and creating new holding companies in different jurisdictions. From Trump's perspective, this was just smart asset protection. But then, when the bank's legal teams caught wind of all this, they absolutely lost it. In the bank's eyes, moving assets while facing a $454 million judgment and while having $5, $2 billion in outstanding loans is just a sign of debtor fraud. Restructuring to put assets out of reach, that's pure betrayal. Any borrower who dares to start hiding assets while holding massive loans is instantly labeled a default risk, and the acceleration clauses get triggered. Now, this left Trump in an impossible spot. On one side, he really needs to protect his assets from the New York judgment and potential future legal judgments. His lawyers are telling him that without asset protection strategies, he could lose everything to court-ordered seizures. On the flip side, he actually has to maintain the confidence of his lenders. That means keeping assets accessible as loan collateral, maintaining transparent financial reporting, and cooperating with bank audits. The tricky part is, all of that requires some level of transparency and cooperation with financial institutions, which directly contradicts the asset protection strategy. So Trump is caught in a bind. He can either keep trying to protect his assets from legal judgments, which means restructuring, transferring ownership, and creating barriers to seizure, and that only makes the banks more nervous and triggers loan acceleration clauses that could force bankruptcy. Or he can maintain transparency with the banks as his loan agreements require, which means keeping assets exposed and vulnerable to court seizures, but that'll definitely expose him to losing everything if the judgments stand on appeal. It's a tough situation, and that's the mess Trump creates for himself. He demands complete financial flexibility and wants to restructure at will without consequences. But then he points fingers at banks when they protect themselves by calling loans. He's not shy about threatening to sue them and claim political persecution whenever it suits him. This whole scenario is causing major stress within Trump's business empire and political operation. If major Wall Street banks have turned on Trump and are willing to publicly demand $5, $2 billion in immediate repayment, every business partner, vendor, and political ally is left wondering if they're the next relationship to be severed. Those moderate Republicans who are trying to balance their support for Trump with their own business relationships and reputations are now worried sick about being the next ones to get caught in Trump's financial collapse. Meanwhile, the hardline Trump supporters believe the banks aren't aggressive enough in their loyalty and that they're too willing to cave to political pressure. Things became even more intense when Warren Buffett, one of the most respected voices in American finance and someone who usually stays far away from political commentary, broke his silence on Trump's financial situation. Buffett had been pushing for transparency in corporate debt markets and criticized highly leveraged business models for years. During Berkshire Hathaway's annual shareholder meeting on March 8th, when asked about Trump's financial troubles, Buffett said something that really should catch everyone's attention. He stated that when you build a business empire on inflated valuations and maximum leverage, you're not building on bedrock. The warning from Warren Buffett carries a weight that few voices in global finance can match. Known as the Oracle of Omaha, Buffett built one of the most respected fortunes in modern history through disciplined investing, patience, and an unwavering commitment to conservative financial principles. For decades, he has avoided criticizing individual business leaders, choosing instead to speak in broader lessons about markets and corporate behavior. That is precisely why his recent comments have drawn such intense attention across the financial world. When Buffett suggested that a business empire built on inflated valuations and extreme leverage is like building on quicksand, many observers interpreted it as a thinly veiled warning about Donald Trump's long-standing financial strategy. In Buffett's philosophy, sustainable wealth is built on solid fundamentals, cash flow, transparency, and manageable debt, not on aggressive borrowing supported by questionable asset valuations. Financial journalist Andrew Ross Sorkin emphasized the significance of Buffett's remarks during a recent broadcast, noting that such commentary represents a meaningful shift in how parts of Wall Street view Trump's business reputation. According to Sorkin, when a figure as politically cautious as Buffett feels compelled to highlight the dangers of highly leveraged business structures, it signals a broader loss of confidence among financial insiders. Over the past several weeks, analysts across both conservative and progressive financial circles have begun describing Trump's corporate structure using phrases such as quicksand foundations and unsustainable leverage. These are not casual criticisms. They are technical warnings about a model that relies heavily on borrowed capital while the underlying asset values remain contested. In financial markets, credibility is everything. And once lenders begin to question valuations, the entire structure of debt financing can rapidly become unstable. This financial tension carries enormous political implications as well. Trump already faces multiple legal challenges, including criminal indictments and major civil judgments. And those controversies have complicated his ability to raise campaign funds for the 2024 election. If lenders begin aggressively pursuing repayment of billions of dollars in corporate loans, the political consequences could be dramatic. A candidate who built his political identity around claims of business genius and economic competence would suddenly be confronting the possibility of bankruptcy proceedings during a presidential campaign. For voters who equate financial stability with leadership ability, such developments could raise uncomfortable questions about whether Trump's business success was as strong as he has long claimed. Political strategists on both sides understand the narrative power of this situation. Democratic campaigns would almost certainly highlight financial disputes and court rulings as evidence that Trump's self-made billionaire image was exaggerated or built on misleading financial statements. Campaign advertisements could juxtapose Trump's public claims about business mastery with reports of loan defaults, lawsuits, or creditor disputes. The argument would be straightforward. If a leader cannot manage his own financial empire responsibly, how can voters trust him to manage the economy of the United States? Whether that argument ultimately persuades voters is another matter, but from a political messaging standpoint, it presents a powerful storyline. At the same time, the financial showdown raises deeper questions about how the American system handles potential conflicts of interest involving powerful political figures. Banking regulators traditionally emphasize that lending decisions must be based on financial risk assessments rather than political considerations. If large financial institutions begin making aggressive moves against a prominent political candidate, it inevitably invites accusations of political bias. Trump and his supporters have already argued that actions by banks, courts, and regulators represent coordinated attempts to damage his political career. Such claims, whether accurate or not, complicate the banking system's effort to maintain a reputation for neutrality in credit decisions. However, financial institutions also face their own obligations. Banks are required to protect shareholders and maintain responsible risk management practices. If lenders believe that collateral values have been overstated or that borrowers are attempting to move assets beyond the reach of creditors, they may feel compelled to act quickly. In that context, the tension between political perception and financial prudence becomes unavoidable. Banks must decide whether protecting their financial interests could also trigger a political firestorm, while political figures may argue that ordinary financial enforcement is being used as a weapon. Beyond the immediate dispute lies an even larger constitutional question. How should the United States handle the financial obligations of individuals who seek or hold the presidency? The Constitution includes provisions such as the emoluments clauses designed to prevent presidents from being influenced by foreign governments or private financial interests. Federal ethics laws similarly aim to ensure that leaders do not use public power to resolve personal financial problems. Yet modern political campaigns have raised new complexities. A candidate carrying billions of dollars in corporate debt could face enormous pressure from lenders, investors, or foreign financial institutions that might acquire portions of that debt. Such scenarios raise troubling possibilities. If a president owed massive sums to private creditors, what would prevent those creditors from